Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, January 16th, 2025. It is 11:36 a.m. Eastern Time as I'm starting the video, and I'm just going to do a potpourri mix of just the things I'm watching, where I think the opportunities are right now. I want to cover what I haven't done in a while, some of my sentiment indicators, showing you what they're saying. And then what I think I'm going to do is bring the video home with a view of the longer term charts. I keep talking about compartmentalizing or differentiating near-term outlook and trading opportunities on anything, whether it's usually the broad market, but whatever you're trading, and then longer term. So we'll do that towards the end of the video. We'll get to the equity markets. Let me just start out with crude oil. I mentioned yesterday, liking this one, giving it some room, shorting it a little while back, but adding to that recently, and then this morning. I'll let you know I rolled from the February's to the March. So let's look at the March contract, and I'll give you the targets. There's more volume in the March contracts. The CL now. Oh, for you ETF ETN traders, USO, which I covered yesterday. That's your go-to. Here's where I think at minimum we're going to go down to. There's an uptrend line that comes in with this 76.20 support right there. I think that's a pretty good shot at minimum. And if that trend line breaks, then maybe get back in, and we'll see. But as of now, let's try to game this little pullback off that divergent high. That'd be about a 4% or so drop on crude. Let's see what's next. I'm not going to go over each and every chart. Just a quick update on natural gas. Remember, natural gas is one of, if not the most volatile commodities out there. So, if you're... And I'm going to speak to a little bit more on this towards the end of the video as far as that active trading thing goes and typical swing or trend trading. But, if you're an active trader and you're very nimble, you can kind of get in and out and trade the little, what I call micro squiggles within a trend. But they can be pretty powerful. I mean, these are the rips and dips. We had this divergent low. We've been walking our way up here. I've been maintaining a target just shy of $5 for quite a while now, based on the long-term constructive nature of the charts. And but when you see these rips and dips like that one that morning I highlighted there, we were up 25% in a day, and you had a pullback of about 20%. So, if you're swing or trend trading it, you do have to either, first of all, be comfortable and know what you're trading. I always say it's a thing I've made up. When I was a stockbroker back in the day, financial advisor, we had a rule. I forget the rule number now. It was FINRA's predecessor. Now it's FINRA that takes care of that. It was the Know Your Client rule. And you had to know everything about their financial net worth, their objectives, their risk tolerance before you could make a recommendation. And I have a rule in trading. I call it Know Your Security rule. If you're new to this and you just start trading natural gas or Bitcoin and you're trying to use, 3-5% stops, well, I'm going to tell you, you're wasting your time. You're going to get stopped out, even if you're correct on the call and where it's going, in just that daily back and forth grind. So in other words, when you see something, take a look at the chart. Even if you haven't traded before, it's easy to look at the charting history and what are the daily swings? What are the swings within a trend? What kind of trends do you try to catch? On natural gas, when I'm catching a primary trend, I'm usually looking triple digits. That's 100% plus. Now, if I'm trading treasury bonds, I'm happy to get a double-digit gain on a swing or a trend trade, right? I'm going to put a lot more money in treasury bonds. My stops will be tighter. My profit targets will be smaller, but that oversized position or bigger position size makes up for it. You go into something like Bitcoin or natural gas, you got to take that position size down a lot smaller, much smaller, a lot smaller than treasuries, even smaller than equities. But it's still worth your while, because even on a fractional position size, let's say it's a quarter, one half, what you usually trade, you're going to have outsized gains, and also gives you room to allow for bigger losses. Because at the end of the day, percentage terms are completely irrelevant to me on any trade. It's how much I make or lose in dollars, because that's what's going to break or make me. And so that's it comes back to position sizing. So NG still looking for that last thrust up. We've had several pullbacks to this uptrend line right here. You've got gaps here. Again, I don't have the the long-term futures chart pulled up right now, but I've covered that quite a bit lately. So I just wanted to update that I still like that. Still long natural gas, short crude oil, and that's that. Let's move on to the next one. I'm not going to cover the grains today. They're just taking a breather. They're still, the breakouts are still intact. They look constructive. One of the trades that certainly still offers a very good risk reward and looks very good are Treasury bonds. This is TLT, the 30-year ETF. There's the breakout right there, the bullish falling wedge, and we hit that first target yesterday around 87. Pulled back as expected. If you're an active trader, you could have gained that, sidestep, take profits, short and or buy back in on the pullback. Like I said today, any dips, ideally to support, but there's not a lot of support. That's the first support on TLT, about 86.11, and I wouldn't count on that. This is a powerful setup. This was probably one of the most heavily shorted, most hated trades in a while, which made me really like it and stick with it. You guys know I've been pushing this one for a while, sticking with it. And like I said, the charts just kept looking better and better. So, that's what I'll do. Sometimes I'll take a trade and it'll go underwater and, it's all, and it's not much. We started buying it back here on this first divergent low, I think around 80, right where we are now. But of course, adding to that and adding on the breakout, and that's only down to 2.5%. But again, it's an oversized, overweighted trade. It's also an indirect hedge to equity shorts if you're doing that. Again, I'll get to the equity markets in a second. And so essentially we just need to pop the 87-ish level, yesterday's highs, and that should take us up to the next target, still favoring a run up to about right here, about 89.65. IEF is the 10-year. You can trade it. You tend to get more juice on the TLT just for the higher duration that the longer-term bonds have, but you can see, we're probably going to come up to minimum right here, maybe even more than that. And futures traders, ZN are your 10-year Treasury bond futures. Still looking for a move up to at least right there, potentially all the way up here. Could easily see that. We'll just, take it day by day. Like I said, it's, right now markets the equity markets are volatile. The bond market's really been trending lower, but this is, big spike breakout recently. And so as I've been telling you, it's a good time to stay flexible. Active traders are destroying trend traders right now. The market's been grinding around for months, and that's really, and again, you need to recognize that. That's the other rule I've always made up or learned early on. Recognize what type of market you're in. And I've done a pretty good job. Nobody's perfect, but in anticipating before we get into one of those grindy sideways trends, because those are the trends that tend to frustrate swing traders, even trend traders, investors, and you kind of change hats or change gears. And when you see that coming, or you realize that's probably what started, you start trading it. Sooner or later, we'll break out into a more trending market, and we'll try to then at that point shift away from trading those 5 and 1 minute charts and 5 minute charts, 15-minute charts, and go back more to the daily and weekly charts and 60-minute charts. But as of now, I just wanted to reiterate, as I have, Treasuries still look good on the breakout. Anything's possible. Don't fall in love with it, but as of now, it looks good, and it's also still an indirect hedge to any equity shorts, because as this goes up, that should be net bullish for the stock market, should be, but it won't be if it's a flight to safety bid. And there are times where treasuries and bonds, stocks and bonds, we've seen that in recent years especially. There used to be historically an inverse correlation. One would go up, the other would go down for the most part, with periods of brief disconnects. Well, we've seen a lot more disconnects lately. So as I often say, I like to anything I trade, even if it's indirect hedge, I'm going to trade it based on its own technicals first and foremost. I'm never going to go long anything if I can't make a case based on the charts, nor would I short anything likewise if the charts didn't confirm. All right, I just flipped over to ZB. So what that means is there are times where I might take something as an indirect hedge to a position, but they both play out, and that's why I do indirect hedges. Because if you read the tea leaves properly, meaning the charts, then you can profit on both. But then for the reasons I've stated, and I feel strong about this, if treasuries all of a sudden crap out, and that's it, and this breakout fails and we go down, I can't make the word promise, but I can tell you as strong as I can, my convictions are, with a extremely high degree of certainty, that will be bearish for the stock market. Stock market will throw a hissy fit if we take out the recent lows and go much lower. Maybe a brief undercut's one thing, but you start breaking it down. So therefore, if you're short the equity markets, you should profit if bonds do this. And there's ZB. That's the level yesterday. Told you, reverse, gained a little pullback trade, got back in, and expecting a breakout here. And that should open the door to these next targets. And ultimately up here at about 115, 160. Like I say, always sell just shy of resistance where you expect a reaction, just in case the sellers step in early. Bitcoin at an interesting junction last few days, including down here, the recent lows on the stock market and Bitcoin. Mentioned that, number one, just like the stock market, I covered this recently, we had a beautiful, what I call bear trap. I highlighted that morning to make sure, got that post out to you. Said that before it happened, the QQQ would be slightly above that first suggested stop I gave you on the 60-minute about a week or two ago. Said I'm going to hold off on that, suspend that, lower that stop because we're probably going to see a bear trap, and that's what happened. And with the equity markets, they did the same thing here. They undercut the recent lows with strong positive divergence on the 60-minute chart. And then, as I said, if the stock market rallies, especially the tech-heavy QQQ, that's a risk-on trade. Bitcoin will rally, but Bitcoin will rally more. So if you took Bitcoin, then you made about 13 or so percent, and now where we're at, we've come full circle. We've hit downtrend line resistance, and again, not mere coincidence. What did we hit this morning on QQQ and ES, or the futures I showed you? But we hit the downtrend lines right there, and so these charts are mirroring each other almost because Bitcoin has a very high correlation, especially with the tech-heavy Nasdaq now. Now, I am certainly not above or beyond these guys breaking out, both the stock market and Bitcoin. We're in a larger bull trend. We're above the 200-day moving averages on the market, stock market. And so that's certainly a possibility, and one that you need to adjust for and adapt to if you are bearish. And if you're bullish too, you want to take that breakout. I told you if it happens soon, like today, tomorrow on the markets, I'll get to the markets in a second. I know we're still looking at Bitcoin here, but I suspect that we'll probably go and back test it. So I don't think it'll be a break and run situation probably. So there'll be an opportunity there to either, if you decide to cover shorts, if we break out and it happens real quickly and you're trying to give it a little room. I always like to give room on, let's say on a short trade, a little bit above the level where everyone else is going to see, because that's where all the stops are. And you're going to go through, punch those stops, you're going to run up. And then if that breakout's going to fail, that's when it'll fail. So you always want to have your stop loss orders just at a range of where you think everybody else is. That's how I like to trade, at least. It's just a pet peeve of mine when they clip my stops and then turns around and runs. So try to give it a little room, and that's just kind of an intuition thing. Over time, the algos, both the computers and the trading desks, they know where the stops are, and I can usually look at a chart and see where a cluster of stops is likely to be. By the way, I'm adding a level here. I see nice reactions there on Bitcoin too. Now, if it breaks out above the trend line, whether it's bullish scenario would be a breakout, a back test, and then run up here and break that line I just added at 10. What is that? 10,000 okay, it's 102,928. Wow, a lot of numbers in there. Okay, 102,928, round that up, and that's resistance. That's going to be bullish if we can make a breakout, especially a sustained break. Otherwise, any breakout there that fails and goes back below the trend line. And that's the thing too, guys, about breakouts, bear traps. That would be a bull trap if we broke out and then failed back down below it. So keep that in mind. And if we do break out anytime soon, we could have some negative divergence. But it has to happen. It has to reverse soon. Why do I say that? Because you can see if we popped it real soon, almost have to go straight up, put in a divergent high, and to keep this divergence intact here. If we do much more than just a marginal new high, you're going to take this divergence out with higher highs there. And then what you go on, it will set up a much larger, potentially a much larger divergent high. So this is kind of my outlook on Bitcoin. It meshes with my outlook in the market. And I'm going to get to that again in a second. We've had some long-term sell signals. Where to if Bitcoin fails here? Oh, and by the way, I should have said, it goes without saying, we shorted the market, or I shared that with you to, if you want to short at the trend lines today. But if you shorted Bitcoin here or reversed it from a long to a short, then potentially if we can get some nice sell signals, and I'll get to the levels in the broad market in a second, all the way down here, this would be a nice target for Bitcoin. That would be a drop of, I need to do this when I measure on this particular platform. Go here. That's going to give you about a 21% profit, a little bigger than that, 22. Bring this trend line across. That's what I was doing. About 21, 25% if you take it all the way down here. If you've shorted this, 23% if you shorted the trend line there. So, and then on that too. Okay, so let's say that was your trade. You believe Bitcoin's going to drop, the market's going to drop, take Bitcoin down with it. You can have, I just showed you this is a logical stop somewhat above that level, but you can also quantify it. If you're going for a 23% profit, what's a good RR? Minimum 2 to 1. On Bitcoin, you probably don't want to give it 2 to 1. You could. It's 11, 12% stop. You can go a little lower than that, 8, 9, and then place a stop there, and that still gives you an attractive RR, or risk reward profile. In other words, you don't want to risk $1 to make $1. You want to risk $1 to make 2, 3, or 4. Or more, depending on the trade. So there's your Bitcoin update. Yes, it will most likely depend on what the market does, because that's just what this market is. It's risk on or risk off. And if we can kind of identify with the charts which way it's going to go, you can trade Bitcoin and the stock market together. Like I've said repeatedly recently, it's an overlapping trade, so don't think you're diversified if you're long NQ and you're long, or QQQ and you're long Bitcoin. You're not diversified. You have an overlapping trade, at least at this point in time. Okay, let's look at a couple of sentiment indicators. Those are what we call contrarian indicators. I only use sentiment indicators when they're at extremes. Anything else, in other words, this is the the equity only put to call ratio. So it measures the ratio of put calling versus call buying. For those of you not familiar, a put is a bearish bet. Now they're also used as options are also used as hedges. That's where they initially were really kind of rolled out for, but in recent years, Wall Street has become an absolute, unarguable casino, and that I can tell you emphatically. I mean, we've seen everything from the proliferation of single-day options, binary options. Traders just speculating every day what the market's going to close up or down. Bitcoin, do I need to say any more there? And now, of course, the acceptance of it with all the Bitcoin ETFs. Anyway, there's all that stuff. So even futures now, you can bet as you could on the outcomes of the recent elections, and going forward, you can do that, bet on the weather. So the stock market is just an outright casino. This is a bubble of epic proportions. One day, and I believe in the not too new future, there's going to be tremendous profit potential on shorting the next bear market, and even going long in the bear market rallies there. However, we're going to take it day by day. Been talking about the big bear market coming for a while, and it will, and we'll be positioned accordingly at the time, hopefully. Right now, like I said, it's more of an active traders market. Although we do have some long-term sell signals, which I'm going to revisit here in just a second. All right, on to this chart, CPCE. Again, equity put to call ratio. You can see I have a couple lines here. I have a blue line. This is something I came up with years ago. We'll see if it continues to work. The 10 period exponential, 100 period simple moving average. And pretty much, because what this does is it smooths out. When you put a moving average on any line, it smooths out the irregularities. The put to call ratios, you can see here, the gray lines, it looks like a regular EKG, right? But when you see over time, the put to call ratio moving down, that is net contrarian, especially when the stock market's rising. And so you can see when we hit this line, big corrections in bear markets came, we hit it there. There was the bear from 08 to 09, about a 57% drop, 22% drop. And this is just the S&P 500. Remember, most of these corrections, the NASDAQ was more although it actually matched in the 08-09 bear because the banks fell hard. Same thing when COVID hit. COVID was actually a bigger drop in the S&P, about 36% if I recall, high to low right there. But you can see that this is where corrections come from. This was not the biggest drop. It's what we call a deer market. In between a bull and a bear market is something they call a deer market. Very uncommonly used term, but it does exist, where it's neither bull nor bear. The market goes sideways. This was about a year and a half of sideways trading, and it did have several big corrections in there. So it's one that you could have stepped aside and been glad to if you were a long-term bull, 401k money, that kind of thing. And again, it was foreshadowed by a tag there. And then this tag came here, and there's often a delay, and then the top was in late 2021. Again, it was the beginning, the beginning of the year, January, first trading day of the year, where the S&P topped, but the NASDAQ peaked earlier back in, I think it was November there. And so again, and now, no, that's really not what I wanted to go to, although we're getting very close. I just do want to highlight that. That's something I've used on the chart. These are my buy points. When you spike up here, this shows extreme fear. There was COVID lows right there if you bought it. There was a low of that big drop in the fourth quarter of 2018. That was one of the biggest corrections in years. I don't measure it out. But and so this is when you want to get bullish and long, right? When everyone else is fearful and buying a lot of puts. And likewise, when everyone's buying calls, top is usually. And so let me show you what this chart will show you. There were a lot of extremes back here in late 07, and then the top came. This is this red line. You might not be able to see it in the video. I have a dashed red line. That was the top of the end of the bull market, beginning of the bear, 57% or so drop. Then you had, if you look down here on the bottom, you can see these lines here. I have two lines, a black line I just covered over, and a blue line, a blue extreme line. And either one works. It's usually the tag of the black line there. It's about 0.25. And it's not a timing indicator. It just shows you that bullishness has become extreme with a lot more call buyers and put buyers. And then shortly after, usually a couple months later, comes a top, 22% drop. You didn't hit it there, but you did hit it right here, right there. But the COVID already came. Here is the last time we hit it. Let me just fast forward to today. The last time we hit it was right there, and that's right around when the NASDAQ peaked, but the S&P had a little more upside, as you can see from the black line first, and then the red lines right here. That's where the peak was in, and then the drop. I don't have the drop. I guess the last time I updated the measurements was back there. Obviously, we dropped a lot more. I have to click annotation mode to move that, but that was the drop that we had there in 2022 down into the October lows, right? And it was foreshadowed by a level which we just recently hit. So in other words, another way to say this, we have not seen the put-call ratio drop to that black line since the right before, just shortly before the bear market in 2022 started. And we just hit that level, and you can see there's a lag. Here's how far the lag is. And we're right about that window now from the recent highs. So only time will tell if that was the peak. I just wanted to point this out, that's one thing that would indicate that things got a little frothy there and could end up marking the top. Another indicator that I use, again, not a timing indicator, you want to see extremes, is the AAII bull to bear ratio. And so what that means is American Association of Individual Investors, if I recall right. That's what it stands for. And they do a weekly poll of the members to see if they're net bullish or net bearish at the time. And like anything else, when everybody's bullish, tops are usually in. You can see this was an extreme here, the red zone. Here's a top there. And quite often you'll get these extremes and then it has to abate a little bit, then the top comes. So again, very important when I say that. It is not an exact timing indicator, far from it. It just shows overall conditions. Well, you want to be buying when everyone else is bearish. It's the old saying, you want to buy when there's blood in the streets. I think that one's attributed to Warren Buffett. And so you can see extreme bearishness there. There was the end of the bear market back in March of 2009. Everybody was bearish, thought the world was coming to an end, and you wanted to be buying right now at that point. I'm sorry. And so what we can see is everybody's been bullish. We've been hitting my red zone here where you get these extremes. You get into the red zone. Corrections usually follow. Correction. We made a marginal new high and an even bigger correction. But then quite often the trigger comes. If you see this period of extreme bullishness, when did the market top? Well, right here. I'm going to draw up arrow. So it was really after the bullishness abated and folks started getting bearish. So it's really after a period of prolonged and extreme and extended bullishness like we've had here, and then it drops off. You can see they've just crossed red. So again, it's it's just conditions, not a timing indicator, but that's what this whole thing is about. Is if you're trying to identify a major inflection point in the market, you need evidence like this, and there's a couple things that are flashing the potential that we may be at or already just past the top or very close, if there's another push up in the market. Okay, and that's my segue into the short-term versus long-term thing. This is as you guys have seen a lot of lately, my 5-minute chart. I'm going to mark divergent high here, correction. No, well, that's not my arrow tool. Divergent high, trend line break, correction. Big divergent low right here, rally. Trend line break there. I believe we had the divergence on the futures. I'm not showing you the futures right here. I did show it to you recently. A lot of these smaller rips and dips were identified or signaled in advance from divergences, divergent highs and lows on the futures, and this is the most recent one. So you can see a little QQQ a little shy of its comparable downtrend line, but I showed you this morning we hit it in the futures. In fact, in pre-market we were closer to that, and then I got the post out to this morning. In the NQ and ES futures, we did hit their comparable trend lines. So what does that mean? We could push up a little bit more and get a full tag in the regular session here on QQQ. And if we do, let me just show you what's going to happen if the market rallies today. We're going to have this divergence that we had. It was this morning's open. We can go to that sell signal. We pulled back to my first support level, and so far that's what they're holding. These are the same chart I've been sharing the last few videos. I believe all these levels were there. I have it on NQ as well. Pretty decent near-term support. And if the market pushes up a little bit more, it's going to hit the trend line on QQQ. It might be a hair above the NQ trend line at that point, probably will be, but then you'll hit it on QQQ and these sellers will probably step in. If it happens anytime soon, as I'm drawing right here, you're going to have negative divergence on this 5-minute chart. I would say there's a pretty decent chance of that happening too. Let me show you NQ. Yep, this is my 5-minute chart of NQ. You can see nice reaction high there. Gave me this support level here. It's comparable to what I just showed you on QQQ. 21,353 right there. Reactions. So far, that's where they're holding. That was this high today when we hit the trend line. Again, that was a trend line on the longer term. This is the 120-minute chart that I shared with you, which is this chart right here. It's one I've been sharing the last few days. There's that trend line. So that's a trade. So again, if your head's spinning right now, because I'm jumping time frames, I'm showing you little, these are very profitable if you trade futures. That's a 1% pullback off the trend line. And so far, we're holding support. I'll keep it very simple. No guarantees, but break of the recent lows, we will have clearly taken out that support. Same with the QQQ, and a break of this downtrend line right here will likely give us that last thrust up and then hit the trend line on QQQ. And if so, just like QQQ, as I drew out, we'll still have, if it happens anytime soon, that's the condition to it. It needs to happen soon. Because if you go sideways for a while, who knows how these indicators are going to look. But if it happens soon enough, take these lines across, it should still be a divergent high and then set the stage up for another shorting opportunity, especially if the trend line's on QQQ and or SPY hit. So that's short term, right? And again, trade as you want. These are, you can go to a 3-week chart, 15-minute candles. I'll draw this out for you. I'll update it. This is a most recent divergent high this morning. There's the trend line right here. I got to bring it across that we hit on the futures. On the 60, I just showed it to you. We were all the way there. I have to go back to the left of the chart, fit it a little better here. And that was the divergent high on the 15-minute chart too. So that gave you that 1% pullback. Again, same support level I've had on this chart. If you look at the last couple 15-minute charts I've shared. So that's, where an active trader could have stepped in, covered. But now I'm going to go to the long-term charts and show you why I'm in kind of a bear bias mode. Now, what does that mean? You've probably heard, if you've listened to, everybody's got their own opinion. There's so many experts out in the financial markets and trading out there, especially with the proliferation of social media and the internet. Everybody's an expert. Everybody's got something to say. And the one I hear a lot is don't have any biases to the market, just trade the charts, blah, blah, blah. You have to have a bias. You have to have an idea of when, okay, if you see something rallying like today into resistance, trend line, if you have a bullish bias, you're not going to short there. You're going to hold off and wait for a breakout and then go long, or you might even go long in anticipation of a breakout above that trend line. If you have a bearish bias, you're going to short there or pass on a breakout. Like I said today, if we pop those trend lines, if we would have this morning, I told you I would have suspected that the breakout would at minimum come back in and back test the trend lines here. Let me show you what I'm talking about. And so this is where biases to me are absolutely necessary. It's just part of my trading. And so had we popped this morning and done this, I would have put very good odds. I would have sat tight and probably even added and waited for a back test. And at that point, either depending on how things look, I'll be looking at every single of the top, at least the top 10 components of the NASDAQ 100. I'll be looking at the S&P 500. I'll be looking at Treasury bonds to decide whether to cover those shorts and then go long there on a back test of the trend line, or hold tight and wait for a failed breakout, false breakout, which would be quite bearish. Kind of leaning that way, guys. Why? Now we're going to segue into the long-term charts, bigger picture outlook. So I'm going to go to QQQ. I'm going to go to a weekly chart. I would love to go over a bunch of different time frames, but I don't want this to be an hour-long video. So we're just going to look here at the weekly chart here. Let me make sure I'm on a weekly. Yep. Okay, so this is a somewhat clean board. I'm going to just, it's not the ideal board. I have different boards, so I'm going to add this line here. Wondering where that that must have carried through on the 60-minute chart. Yeah, let me. All right, I'm just going to stick with just let me highlight this in blue here. All right, this is the current divergence that we have right now on the weekly time frame. And this is much more significant and important, especially for long-term traders, swing and trend traders. So as I've covered quite a bit recently, we've had multiple sell signals. One came in the form of a bearish engulfing candle. That's when the body, the fat part, engulfs the previous candle and or any other previous candles behind that one. And that's what we had there. That's a potential topping stick. And as I said that week, it's a very simple strategy, and it offers tremendous RR. It may not play out, but when you take it, you short the bearish engulfing, or when you're heading into the close on Friday, because this is a weekly chart, so you had to have it closed on Friday to finalize that candle, and you short with a stop above, and you're talking a few percentage points maximum on your stop to make up to my downside target's 50%, a long-term swing target. So that is a trade that you may be in, and then if so, and you don't do this full time, you're not experienced, you're confused as hell when I'm long and then I'm short and then I'm long on the 15-minute charts, don't try to be what you're not. Don't try to active trade. You'll get cut to pieces, especially in this market. Then if you are a long-term swing trader, you took a short there, that's your stop and that's it. And you're still good. You're still profitable. You've given back a little this week. But if you can't ride out on a long-term swing, it's just like investing. Think of it investing in reverse. When I talk about a swing short trade with a 50% profit potential, that's just like being long in reverse. And when you're long, you either ride out these dips or you embrace them and you buy to add to your position on pullbacks, right? That's same thing, especially in a bear trend. If you're shorting, the counter trend rallies are going to be more powerful. They're going to be swifter, usually a lot faster than corrections in a bull market. And so you just have to know that and expect it, and then sit tight. Again, if that's your trading plan. Then following the bearish engulfing candles, as I mentioned, we had a breakdown there of the primary uptrend line off the August 5th lows, something I've been harping on for a long time, waiting for as a next and pretty powerful sell signal. So with that being said, from the weekly time frame, I've had not one but two decent sell signals on QQQ. We even had a pretty much, let me just pull this trend line and either way, close to a back test. I think it was a back test there on the maybe on the daily. Let me look at the other time frames for you. Again, there's what it looks like right now. We're still well below the uptrend line. We're below the bearish engulfing candles, so nothing's changed there. Well, now we are above the 200 days. I can sit here all day long and tell you how many of my long-term trend indicators are still bullish. When they go, it's going to significantly increase my odds, especially on a weekly basis. When we close a weekly candle solidly below the 200-day moving averages, which on a weekly chart, you want to plug them in as 40-period moving averages, because there are 5 days in a week. 5 times 4 equals 200, or 5 times 40 equals 200. So that's the same thing as on a daily chart, the 200-day moving average. We take those out, that's going to be a big check mark and significantly increase the odds that this was the top and that we're going to go down to my other targets, right? All right, let's go to look at the top components. Apple. Again, this is a weekly chart. I have different boards. This one tells me to look at board 5. We'll look at board 5. This is big. Remember, I'm on a weekly chart. Let me roll out so you can kind of get the scope of it. These divergences on the weekly chart typically build over periods of months or even years. And you can see what I've done here, and I've covered this many times. I have all the divergent lows and divergent highs marked, and I have the amount that followed on the weekly chart. The drop, 83% in Apple. After that divergent high, it was 62%. After that divergent high, 45, 34, 39, 32. And the only thing that has changed since this was the divergent high there, it was back in early 2022. Apple dropped 32%. The only thing that's changed in the chart since then, at least from the divergence, it's grown larger. See, these other times the divergence was reset after the correction. Right? There was no longer divergence. We went on, took out, made new highs. So this was the divergence line right there when Apple dropped 32%, which in my opinion was the initial shot across the bow. This divergence, again, has not only not been taken out, but it's clearly very much still intact with lower lows on the indicators. And so this indicates to me when it finally does play out, there's no hard set formula, but typically the bigger the divergence, the bigger the ensuing trend reversal. And so that's probably going to bring Apple back down to at least that 128.25 level, which will be a drop of about 50%, which is right in line with my QQQ targets, which if I didn't share with you, if you're new to the site, those are on this board right here. T7 down here, 260.56, and that's roughly 50% drop right there. All right, let's go to NVIDIA now. What I'm doing, guys, I'm clicking in order as I often do. I have to the left of the screen here, I have my watch, or the component list of the NASDAQ 100 sorted by market cap right here. And so as I go through these, I always start out with the biggest one, which was Apple, and because that's going to have the biggest impact on the index. The NASDAQ 100, just like the S&P 500, is a market cap weighted index, meaning it puts a bigger weighting on the market capitalization of a stock. And it's much more concentrated in the NASDAQ 100. So that's why I'm looking at this. Okay, what can I tell you? Busy board on NVIDIA, but bear with me. I'll just draw the lines out. I've covered this many times. This is the primary uptrend line in NVIDIA, which was recently broken and back tested, and we got rejected following the back test here. Let me make the line very visible and thick and clear, and we'll color it up blue. We'll make the extension blue, and that's it. So there's your breakdown back test of NVIDIA. So remember, Apple also breaking down below that April trend line. The two largest I have on sell signals via breakdowns of their weekly trend lines. Microsoft broke down a while ago. This was my primary uptrend line here. We had a breakdown impulsive. Way back when I drew these purple arrows indicating how I thought Microsoft would play out. And so far that has now, arrows show you the moves to where, I expected to go, kind of the reactions to come from. So I had it bouncing up to about right here. It did that, but it just went sideways on it since. So it bounced about where I expected. And so at some point soon, I expect the next leg down to come, take us down to about 363. Given, depending on what's going on elsewhere, probably get a reaction there. Next leg down. Arrow breaks denote reaction, so a reaction on 313. And some of these reactions are going to be tradable bounces well into the double digits. Right now, can I tell you with the highest degree of confidence, if we hit 313.66, are we going to bounce? No, with a pretty good degree of confidence, but it depends on how everything else looks at the time, how the other components look, how the indexes look, and of course, Microsoft, how it looks. Meaning, are there divergences? Are we extremely overbought? Is everything else, or most other key stocks and sectors coming up on, and indexes coming up on support or not? And then that just, we'll decide, whether I try to game a bounce, get back in short. And again, whether I'm trading Microsoft or not, I'm usually not. Usually when I have a case, especially for swing trading, if most of the Mag 7, Mag 8, Mag 10, whatever you want to call them, are on sell signals and broken down, they're going to pull the whole NASDAQ 100 down with it. And then, I'd like to trade futures for pure efficiency. Sometimes I'll overweight or overlap with individual shorts on some of my favorites. I'll go long Apple like we did off the lows in 2023. I stated Apple and Amazon as my two top picks, I believe it was. Overweighted those, and with an overweighting on the NASDAQ 100 for indexes. And so sometimes I'll kind of add on. But futures, if nothing else, besides the round-the-clock liquidity, and the extreme leverage it allows you, which can kill you if you're new to trading, investing, and you start getting into futures or even options. They'll give you way more leverage than you need to hang yourself. I promise you that. So be very careful with that leverage. I like it because I can lever up a portfolio to many times what my dollar value is, but be diversified. So if I'm pushing a heavy concentrated leverage position in the NASDAQ 100, but I'm heavily hedged with treasury bonds, then and other things, and I have commodities. So therefore, you can take a portfolio, whatever your number is, 100,000, and have a couple $1 million of securities. But you're diversified. That's the key. So use that leverage. If you're going to use it, make sure you are well diversified. And my advice to anybody new, not that I can give individual investment advice, be careful. Don't use leverage. Cut your teeth on trading non-leveraged index ETFs and individual stocks. And then when you have kind of honed your skills, you can start expanding into there. But remember, don't use it to be in an over concentrated position that's exposing you to a lot of risk. That's usually the demise of early traders once they delve into those highly leveraged products like futures and options. All right, so you can see again what I'm doing here, guys, is highlighting the long-term outlook on these stocks. I'm going to turn off the lines now and show you that what's happened. Why is Microsoft broken down but just gone sideways? Well, it hit those almighty 200-day moving averages. You see them on here? See these blue and red lines? Again, on this weekly chart, it's the 40-week exponential and 40-week simple moving average. And it just does a phenomenal job of defining bull and bear trends, especially in tech stocks and tech-heavy indexes like the NASDAQ 100, even the S&P 500. Tech's the largest sector by far at a 25% weighting, and it's simple stuff. When a stock or the index is below the 200s, above, you're in a bull trend like you were here. Goes back, you buy pullbacks to the 200s, or you short breaks of it. If it breaks and you took the short, again, I wouldn't do it just on Microsoft. A great example is Microsoft took out the 200s here that week on the August 5th lows. I acknowledged that, but told you we were still going to cover all our shorts, or I was, and going full aggressive long. Even though a couple stocks had pierced their 200-day moving averages. Why? Because the majority hadn't. The majority, including NVIDIA, were hitting trendline support, hitting their 200-day moving averages, or the indexes were. And so again, you got to take this stuff collectively. So you don't go shorting Microsoft, that's shorting the snot out of it because it broke and the 200-day moving averages. In fact, you can see really if you're going off a weekly chart, it's again the realm of the swing and longer term swing and trend trader. all that matters, as I say this often, is how the weekly candle closes. So at 2 p.m. on Monday or even Wednesday or even Thursday, it doesn't matter, because you can see what Microsoft did this candle that week right there. We hit a low of 385.58, well below the 200-day moving averages, which were at 405 and 409.51. You can see my pop-up box to the left tells where they were, only to close the week back at 406.02, which was back above the red line, the 200 simple. So this is why this was a reversal candle. And so that would have kept you, if you were trading, let's just say in a vacuum, you didn't have access to QQQ, SPY, and all the other components. You were only allowed to see Microsoft chart. You wouldn't have taken that short. You would have said, oh, intra-week break, but we close the week right back above the 200 exponential moving average. So I'm going to wait till there's a solid close. Okay, so now going back to the, why did Microsoft break down in advance of the other ones? Here, it started going down pretty heavy. And why has it gone sideways? For two reasons. First and foremost, mostly because the NASDAQ 100 and S&P are still holding well above their 200-day moving averages, as are the majority of the other Mag 8 stocks. Number two is it hit the 200-day moving average, which is key support, and they've been buying, as they do, both humans and computers, buying all these pullbacks to the 200-day moving averages. So whether it's next week or 6 months from now, when you get a big red candle through here and a weekly close down below, it's going to be pretty safe to say, especially if the other Mag 8 or most of them are down below there, especially if QQQ and SPY are below the 200s, that you have now entered a new bear trend, just like you did here when the 200s clearly gave way. Then they shorted the rallies back to them. They shorted the rallies back to them. They shorted the rallies back to them. You kept in a bear trend. It kept you short, even let you game those bear market rallies and get back in short and milk additional gains. Remember, we went long both big counter trend rallies that we had in that bear market in 2022 with a net short bias throughout, and then covering and active trading going long those two counter trend rallies. And then this is where the 200 days were finally recovered, and this is where I put an overweighting long on the NASDAQ 100 and highlighted, I think, again, it was Apple and Amazon as my two top picks. And so that's it. So we regained it there. Bull market, bull trend. Pull back, pull back, pull back, pull back, pull back, pull back. So let's see where this is, again, whether it's next week or, 6 months or more from now. Let's see, give you Alphabet. You've got the big, again, if you roll back far enough, you can see big divergence. This is the divergence that's been building for a couple of years now, several years, just like back here. It was several years leading up to the '08 highs, right? Started building in 2005, actually right here. My line should really start there. That's where our divergence started. And then finally it culminated with a divergent high and a blow off top, if you want to go back and look at it. And this is just like now. Nobody wanted to short. All the analysts are bullish. Listen, I don't watch TV much, not CNBC. I'll turn it on to catch the economic events and then turn it right back off. I'll get most of my stuff through reading. And I can tell you, they're still clamoring the same permabulls that were clamoring for a good, strong, good year in 2024. Most of them are still clamoring now. You get a correction like we had, and the Santa rally never came. And of course, they marched some of the bears out of the woodwork, but that was it. And then look at the final thrust up. That's a signature move of a late stage bull market action. When you see that strong rally into the highs. And then the trend line broke, and also the 200 days at the same time. That was a textbook short entry. And guess what, guys? If you missed it, you were given a gift right here on a back test of the trend line and the 200-day moving averages. And then if you took that, second mouse gets the cheese, right? You made shorting Google 56% in a matter of, you made more money on Alphabet in just a matter of months than bulls made in that same period of time. It took up to that point, it was, 3 years of gains wiped out in just months. And that's what a bear market is. And that's why I love shorting stocks. They are so profitable to trade. You just have to be Johnny on the spot with your timing. It's getting in is one thing. You can't wait too long. But more importantly, getting out. You cannot be the last gal or guy to leave the party when the lights come on. So, anywho, that's what we do. We try to identify those points. And let me fast forward and just tell you that, again, it's the same thing. We've been building divergence, big negative divergence for a couple of years. I've certainly been talking about. We certainly caught all of that, including 2 of the bounces. We certainly were long there in the beginning of 2023 when the NASDAQ bottomed. And now the only thing that's changed since the peak in late 2021, early 2022, followed by that big drop, is the divergence that we had in place then has only grown larger. It has not been reset. That's kind of what the overriding theme here. It's bigger divergence, indicating a much larger drop to come. And when the hard part's the timing. And the timing on this one, you have this uptrend line right here, beautiful uptrend line right there. It comes off the early 2023 lows, and the 200-day moving averages just below as well, which we're riding up. You can see again. A little brief dip, but then a stick save. You can see that green candle closing right back on them there. And so that's it. So turn on those lines together and look how perfect they come in. The 200-day moving averages and my uptrend line coming together. That is a powerful sell signal if and when it comes. We're comfortably above it right now, so the market's not in any risk of breaking down those more powerful sell signals. Alphabet's going to have to drop about 12% on 12% just to get there. But what I would do and what I have done, set price alerts. Set a price alert on the trend line, set a price alert on the 200-day moving averages or 40-week moving averages. And when those go off, check. What do the other MAG 8, MAG 7 stocks look like? Are they also breaking down at that same time? If not, and Alphabet breaks down, but the rest are above their 200s or on or above key uptrend line or price support, then you might not want to jump the gun on Alphabet. It might prove to be a brief whipsaw. Let me tighten my line up there. Okay, moving on. We're not going to cover them all. I'm just kind of giving you this is kind of the State of the Union address, if you will, for the stock market, looking at these market-leading stocks. Amazon, again, big divergence leading into the highs in November 2021, followed by the biggest stock the drop had in many years, 58% drop. Again, one of my top picks heading into early 2023 right there. Why? It was random. We had positive divergence. We were at price targets that I had on many of my long-term price targets from the first on this drop off this peak. Excellent support on Amazon right there. And then we broke out and we regained the 200s, and that's it. So you're above the 200-day moving averages, but you have this trend line right here. This is going to be your first sell signal, a weekly close below that. And then when the 200s go, that's going to be even better when this 176 level goes. And we're right on the trend line. That's why right now, time to be careful. Remember, I started the coverage of these MAG 7s showing you that Apple and NVIDIA, the two biggest, have already broken, and Microsoft. Now, Microsoft broke its trend line so long ago, all that's important now is the 200-day moving averages. So watch those. And so we're getting, we already have the top 3 below trendline resistance, Apple, NVIDIA, Microsoft, but Microsoft, of course, being on the 200s, which now, that needs to go. Meta, and then the other ones, like I just showed you, Amazon and Meta are right on trendline support. Meta, let me zoom in a little bit. I know this is a little bit busy. I have forget about all the horizontal lines. Here's the uptrend line I've been watching right here. And again, I've covered these on the daily charts too recently. The daily charts will give you a kind of a jump on it, maybe get you in earlier. You can take the breakdowns on the daily. Just know that you have a bigger chance of getting caught in a whipsaw, meaning a brief drop below followed by recovery. And what I'll often do, if I think the breakdown's coming, I'll take a starter on a break on the daily and then just wait and see for wait for the weekly candle to give me an additional sell signal, add to that position. Then wait for the 200-day moving averages to go. Again, here's Meta. This is just textbook, buying on the 200-day. Look at that. When they took the 200 days out there after being below in a bear market, it didn't just limp through there; it exploded higher. This is shows the market watches these 200 days, and massive buy orders will come in, and once they're taken out, and that's why you had a big green candle. That was a breakout you couldn't miss. And then after the breakout, you just buy the dips and you buy. They've only given you one chance to buy the pullbacks to the 200s on this one, but you can see it danced on them here, kind of like Microsoft's dancing on them now. And then finally, there was a solid rejection and breakdown below the 200s there, and that's when you needed to get short. And then you wanted to short that first push back. And Meta only gave you that one chance to, if you're again only trading off the 200s. There were other reasons to be short Meta, including this bearish rising wedge breakdown and bearish engulfing at the highs there. So that was the sell signal 1, sell signal 2, and the end of the bear market. Tesla, big divergence again. Ignore the divergences at your own peril. That was the last divergent high. It doesn't look like a lot. This is a log chart, so you might say, it's not even worth it, Randy. Let me measure that for you. Let me grab, that's about the high right there, down to the low. That was only a 50% drop right there. So if you think it wasn't worth shorting or getting out of your longs after that divergent high, you lost half your money into that low. Again, log scaling, that's what it does. If you turn off log scaling, which you don't want to do on a stock like this, it distorts the technicals. That's what it looks like there. So there's the chart with log scaling. Always use log scaling, especially on a stock that has a huge differential in price on the chart, on the time frame you're looking at. And so that's it. So we had another divergent high right here on the weekly, and that was good for a 56% drop off this divergent high, right? We were in a sideways trading range. There was our negative divergence, followed by a 56% drop. There was our next divergent high. Oops, highlight it here. I'm going to measure it for you, grab around the highs, come into the lows, and that was a 76% drop right there. Only thing different now, this divergent high is simply an extension of the previous divergence that was already in place at that 76% drop. Stands to reason Tesla's going to go down a lot lower. If I had to short it today and throw away the key, this would be my target right here. And I'm going to tell you right now what that would mean to Tesla. And I know this is heresy for most bulls out there. Tesla 86% drop. Will I be short Tesla all the way down? No, I'll be long short. I'll be watching it, and if Tesla does hit that target, maybe I'll have an individual short at the time on Tesla. But if so, and the market hits support there, that's a great buy point. Again, depending on what's happening at the time and how the other charts look. But there's plenty of stops along the way, including and not limited to this uptrend line first. So just try to imagine for a second, but what this would do to the stock market, because this is, again, live by these FANGs with their market cap weighting, die by the FANGs. I've covered extensively up until recently. There's no point in covering anymore. The abysmal market internals that we've had, it's a signature of just about every major bull market top. And in my opinion, I can't use the word immutable because that's not literally, immutable means can't be changed, but it's close to almost immutable. It's the analogy I've given before. It's like a gunshot wound to the internal organs, whether you were involved in street violence and a crime, somebody shot you, go to the hospital, you might be feeling all right, but if an internal organ was hit and you're bleeding internally, you're probably going to die. That damage has been done, and there are examples of that. People go to the hospital, think they're okay, they've been shot, and they end up dying on the OR table. The damage is done. Or a hunter might know they hit the deer runs off, they follow the blood. Deer ran for a while, didn't realize it was, and then boom, it dies. That I think is what's happened to the market up to this point, with all the extremes on the put to call ratio, the market internals, and so this market has been shot, doesn't know it. The general public doesn't know it, so they continue to buy. But these technicals, I believe, have a very, very high chance of playing out. It's not immutable, because I have seen at times, whether it's on the weekly time frame, monthly, or even short-term charts, I have seen divergences get burned through. So, nobody can say with certainty that we can't have some kind of blow off top in the stock market and that goes on and takes away the divergences. But it's certainly not what I see as the most likely or probable scenario. So that's it. It's a long-winded video. I did go almost an hour, but the most important thing is you have the levels to watch. And if you're a longer-term swinger trend trader, you're worried about your 401k money, then to me it's pretty easy. Incrementally, if and as each of the key support levels that I've highlighted on the indexes as well as these market leading stocks go, it increases the probability that we're going to go down a lot much further. And at that point, you may want to, when the 200 days go on the majority of stocks, when the trend lines go, you may want to start taking some or whatever your number is out of your equity portions in 401ks, or if you're a flexible trader like I am, add to some swing short positions. Okie dokie, I'm going to wrap it up here, guys. That is it. And I'll continue to dig for new trade ideas. Comments have been pretty light lately. I did reply to a couple here in one of the last updates here, if you want to check that out. Somebody asked about UPS. Was it an active trade? It was. I highlighted the three trade that all the updates are there. We nailed this one. We went in at the lows and sold at the highs, and that's it. You got to click there and go down here and see that. So there's your update. We bought it long here, right on support at 123.75. Calling it up here. We got lucky on that one, which sometimes happens. I addressed that in this post. You would have a standing buy to cover limit order on T2. We gapped up there. That's where your order would have been filled. So that's what counts as the hit on the trade. We got a 15% profit. We turned around and sold it there because that was a final trade, final target. Made that clear in the post. And then UPS dropped immediately from there 16%. And it's setting up nice, by the way. It's looking, if this market can hold up, it just broke out of that same trend line that it broke out of before. But that was it. We bought that stock here, I think it was. We sold it there, and then it turned around and dropped 16%. So this is swing trading. This is in and out. This is why swing trading is infinitely more profitable than investing. Anybody invested in UPS for the last couple of years? This is a stock in a bear market. Remember, these bear market divergent lows, like the one we traded, don't fall in love with them. Trade them as counter trend rallies. That's why I didn't make those potential third and fourth targets. I didn't add to those. I figured this for what it is, a stock in a bear market, a bear trend. They keep shorting rallies into the 200-day moving averages. If and when they take out the 200-day moving averages with conviction, then maybe this one does go up. The other comment that I added, made in there was right here. Go back. Nope. Sorry. Let's go back to home. One more I'd like you to check out. Just kind of some trading tips that I gave. Somebody mentioned about getting a price alert at in the middle of the night. 3 a.m. And look, guys, I've been there, done this, and it's not healthy. If you don't become obsessed with trading, my advice, as I said here, don't let the trading bug consume you to the point of losing sleep at night. You don't have alerts. Don't have your phone alert you in the middle of the night if something goes up. Don't try. It's going to be detrimental to your health and to your trading. You can use OCO orders. That's what I do. One cancels the other. They're the absolute bomb for trading. If you're a futures trader and you had a trend line you were targeting and it was hit at 3 in the morning and you have an OCO order, it's simply one order is to sell at your profit target. The other is your stop loss order. Whichever one is hit first, it'll cancel out the other one. I use them all the time. I use them, I'll keep them running throughout the day, especially if something's getting close to a price target or stop, so I don't have to worry. I don't have to wake up and find out my position just plunged overnight. The futures dropped, tank, I'm short oil now. Let's just say bombs start flying in the Middle East. I could get clobbered if I go to sleep short crude oil and crude spikes up 10-15% or some crazy number. So that's what an OCO order will do, and that's what futures will do. And I don't work for the CME group. I don't promote. There's a lot of nuances to them, but they're liquid around the clock. So if there is that event, I get stopped out my losses are minimal and I don't wake up to a huge gap against my position, which unfortunately in stocks, there's no way around. You go home long or short, UNG or USO, the crude or natural gas, ETNs, every single day you're risking waking up to a big gap against your position that will bypass even the best place stop loss order. And so that's why I like to use, futures, good to cancel, OCO, good to cancel, it's on there till you cancel it. OCO, one cancels the other, and just have to make sure to set the order to be filled outside of regular trading hours. Okie dokie, long video. Just remember, when you watch these things, you can increase the playback speed 1.5, 1.75, whatever you want in the settings, and that gets you through them a little quicker. Okay, this has been Randy Finney with Right Side of the Chart. Have a great day.